Traders, welcome into our Merciless Markets Masterclass. In this immersive session, we're going to be talking about everything related to day trading. We're going to be talking about what the hell is the stock market, how does it function. We're going to be understanding the differences between fundamental analysis, technical analysis, how to find stocks to trade, how to recognize patterns, when to buy, when to sell, all that good stuff. But most importantly, we're going to be narrowing down our vision and discussing the hyper-scalping strategy. This is a brand new emerging strategy that focuses on micro movements. Usually most traders think that if you buy a stock at $5 and you sell it at 503, 505 or 5 to 10 cents, usually people don't think they can make money out of micro movements like that. What are you going to do with 3 cents? What are you going to do with 5 cents, 10 cents? That's nothing. But what they forget is that with free commission brokers and with large amounts of capital, you can really make a living out of the market, even with these micro movements. Our philosophy here is the following. What's easier to predict? How far or how low the stock is going to go in the next 5 seconds, whether it is 5 cents up or 5 cents down, or what the hell is the stock going to do in the next hour, in the next 2-3 days, in the next few weeks? For us, our philosophy has always been it's easier to predict what is the stock price movement going to be in the next 5 seconds and try to capitalize off of that rather than predicting what is it going to do in the next few hours. The hyper-scalping strategy has been working exceptionally well for me, exceptionally well for a lot of our mentors here at MMU. We've been making a living out of this strategy for almost a decade, and it's been also working for a lot of our members. So in this session, our hope is that you get a taste of the strategy and decide whether this is something you want to pursue or not. All right? So let's get started here. So before we carry on, I just gotta go over a quick disclaimer. Just a reminder that I'm not a financial advisor, a reminder that I'm not a CPA, a reminder that I'm not a CFA, and that nothing here should be taken as financial advice. All the information discussed in this course or any of the Merciless Markets University's education is intended for informational and educational purposes only. Trading stocks is very risky and our results are not typical, and most traders do lose money indeed. Keep in mind that you are accountable for your own decisions, wins and losses. This information is not to be constructed as an offer, recommendation, or solicitation to buy or sell a specific stock. This is not financial, tax, or investment advice. There are no guarantees that this course or any of the Merciless Markets education will make you perform better than the average losing trader. Please review our full disclaimer in our website before you carry on, and in simpler words, understand that mastering the art of trading is extremely difficult. 90% of traders that attempt to become profitable eventually fail, okay? And we here don't give guarantees that you're going to come out of this program a successful trader. We simply are telling you what works for us, the strategies that we follow, the techniques that we follow, and we genuinely do believe that we can increase your probabilities of making it as a profitable trader. We can shorten that learning curve so that it doesn't take years for you to master this art. Instead, it only takes a few months or a year or two, which we've actually seen with a few of our members. So it is happening. And even though the odds are against you, who's to say that you might not be one of the ones that get the strategy, that gets good at it, and that becomes a profitable trader and hopefully starts making a living out of the markets. All right, first things first. If you've been trading for a while, this might be way too superficial and basic for you, so feel free to skip along. But for any beginner trader, we're going to quickly talk about what is the stock market? How does it function? Why was it created? All right, so the stock market is simply a virtual market, as the word explicitly says it, in which buyers meet sellers and they exchange goods. Okay, just how you can go to a farmer's market, you can exchange money for goods, for apples, for cheese, for cuts of meat, so on and so forth. In the stock market, though, it is a virtual market in which you exchange money for an asset, and this asset in this case is a stock, a security. The two parties that are meeting in the stock market are buyers and sellers. Usually buyers are people like us, investors, traders, right? Retail traders. And the sellers are usually people that are wanting to raise money for their own business operation. For example, Elon Musk selling shares of Tesla to raise capital to further invest in AI or to further invest in self-driving vehicles, in electrical vehicles, or Starbucks, McDonald's, Coca-Cola selling a portion of their company in exchange of money so that they can continue their business. I'm going to give you a quick example here on how does it work. Imagine you yourself live in a very tropical area, and for whatever reason, you have dozens of lime trees in your backyard. Because of that, you've decided to put your own little business. You're going to start your own Lemons LLC, kind of like lemonade drink shop, right? You start with your own savings, a few $1,000s. You invest on a table, you invest in some equipment, maybe you pay yourself as an employee, and then you start selling lemonade drinks or whatever type of drinks you come up with on the street, right? The whole idea with a business is to eventually scale it and grow it to a different and bigger version of it. But what do you need to grow a business? What do you need to go from a table to a full-on mini restaurant? And then from a restaurant to a full-on Starbucks-like empire? Well, you need money. You need money to hire more employees. You need money to buy new locations. You need money to invest in marketing, advertising, all that good stuff. Eventually, you're going to need more money to have massive buildings, HQs, massive facilities. You're eventually going to start developing your own lemonade powder and start investing in R&D, so on and so forth. So you need money to grow a business, okay? So how do you raise that money? You can take two routes. You reinvest the profits that you make from your little business, assuming that it's profitable from the very beginning, or you look for capital elsewhere, and that money can be received in as debt or as equity. A debt would be a typical case in which you show up to your local bank, you show them your business plan, you show them your credit score, and then you ask for a loan. Can you loan me X amount of money so that I can reinvest in my company? And because of that, we're going to sign a contract that says, I owe you this money, and thanks. And as a thank you, I'm going to pay you yearly interest of X amount, right? And hopefully in 5-10 years, I'm going to repay the entire loan. And the bank makes some money thanks to the interest. And you also get to grow your business a little bit. The other version on how to raise capital is via equity. And here's where the stock market comes in. Here's why the stock market was created. What if you live miles and miles away from me, but I want to invest in your company? I want to invest in Lemons LLC. Now, thanks to the stock market, if you enlist your company in the stock market, I can go ahead and give you my money, right? So you can invest for business operations. And in return, you're going to give me a little piece of Lemons LLC. Let's say it's 1% of the company. I give you $1,000. You give me one share, let's say, and at that time, one share is the equivalent of 10% of the company. If I am right and you are a good horse to bet, you become successful and you grow this business into a lemon stand to Starbucks, then that one share that cost me $1,000 might be worth $10,000 in the future, $100,000 in the future. Because you got to remember, the price of a stock is completely related to how the fundamental company is doing. Is it growing? Is it making money year over year? So on and so forth, right? And within this world of the stock market, in which the idea was for investors to give money to business owners, and in exchange, business owners get money and investors get a little small piece of the company, this world of trading, stock trading, was created because the price of a stock, at least in the short term, not always 100% accurately represents the fundamental value of the company. And within these discrepancies is where us as traders can come in and try to capitalize and position ourselves to make money out of those discrepancies, because eventually they will get to a point in which the price actually accurately reflects the value, the intrinsic value of the company. But anyways, this is why the stock market was created. Now all of this is dealt via virtually online. You can go ahead and buy some shares of Tesla. You can go ahead and buy some shares of Apple, buy some shares of Microsoft, buy some shares of whatever. Let's say I genuinely believe AI is the future. I believe in robots mowing our lawns or making us breakfast. And I think Tesla is going to appreciate as a business, hence appreciating the value of their stock. And because of that, I want to invest in Tesla. I want to invest in Elon Musk. I go onto the stock market, I grab my hard-earned money, give it to Elon Musk, give it to Tesla. In exchange, I get a few shares of that company. And if I am right, in the next 5 years, Tesla is going to grow as a business. AI is going to be the next big thing. The prices of my shares are going to increase and they're going to appreciate. And the difference between of the cost of how much it costs to buy those shares to now how much they are worth 5 years later, that is the profit I get as an investor. All right, so this is the stock market. Again, everything here is very surface level. We are not going to dive deep dive into any concept. After all, this is just a masterclass to give you a little taste of what MMU is about. But in the courses and in our programs, in our live coaching is where we literally make whole classes, whole courses out of concepts that we are just going to briefly touch during this masterclass. All right. So how do you go about knowing which businesses to invest in, which businesses or stocks to buy? Well, you can do analysis. And there's two types of analysis: fundamental analysis and technical analysis. Fundamental analysis is the idea of pricing a stock based on the true value of its business. A fundamental analyst utilizes factors like balance sheets, income statements, forecasting statements, cash flow statements, business strategy, sector and industry in the business, so on and so forth. And here's a key factor: business strategy and sector and industry of this business. What I was just telling you about Tesla, me thinking that AI is going to be the future, me believing in self-driving vehicles, me believing that electrical vehicles is the only sustainable way for us to drive around in the future, because eventually we're going to run out of gas, run out of oil. All that is fundamental analysis, is the business strategy, is the industry that this company is in, okay? And the aim of fundamental analysis is to determine what is the intrinsic value of this business. Fundamental investors do not rely on charts, they don't rely on indicators, they don't rely on stock prices to make decisions. And for the most part, when it comes to long-term investing and when it comes to long-term value of a company, it is best to be utilizing fundamental analysis for you to determine its value. But because we're not investors, we are traders, we're going to focus more on technical analysis and try to capitalize on the rapid, volatile price action that these securities may have before they caught on to the fundamentals. So technical analysis is the art of predicting a stock prices based on historical price action, based on volume, and based on trends. Technical analysts utilize tools like trading charts and technical indicators to predict price moves and profit off of them. Unlike fundamental analysis, technical analysis does not attempt to measure the true value of the business. As technical analysts, technical analysis is mostly used for short-term trades versus long-term investments. And this is exactly why we care more about the technicals than the fundamentals. At the end of the day, we do some fundamental due diligence. For example, we want to be aware what is the type of stock we're trading, where is it located, in which sector of the industry is it investing in, what is the type of business that we are essentially buying and selling. I would say 20% of our analysis is fundamental. It's a quick overview of what the company that we are trading is. But then 80% of our executions is based off of technical analysis, based off of historical pricing, based off of how usually the prices of this security move like, based off of support and resistance, indicators, and all that. Technical analysis and fundamental analysis can be used simultaneously for better returns, and this is somewhat what we do here. A little bit of fundamental analysis just so that we are not clueless of what we're trading. But when it comes to buying and selling, especially within the hyper-scalping strategy, we're looking for those micro price movements, which are generally dictated based off technical analysis rather than what is the true fundamental intrinsic value of the company. All right. Okay, so now that you somewhat understand what is the stock market, at least at a surface level, how do you make money out of the markets? How are people making money out of the markets? There's 4 venues that are very popular that we usually teach here at MMU. Those are long-term investing, dividend stocks investing, swing trading, and day trading. Long-term investing is an investment strategy focused on capital appreciation and taking advantage of compound interest. If you have a 401k, Roth IRA, assuming that you're an American, or if you have any pension funds in which you expect to retire with in the future in 10, 20, 30 years, depending on your age, usually the strategy your financial advisor is pursuing is a long-term approach. It's finding a pool of assets that are reliable, that have a good track record. For example, ETFs, for example, investing in the S&P 500. S&P 500 is an ETF that follows a mutual fund called S&P 500, SPY. Okay, this is the ticker if you want to look it up in the internet on your own charting software. The SPY, S&P 500, is a pool of stocks, and when I say stocks, I mean companies, of the best 500 companies in the entire US, which usually means the best 500 companies in the world. This is a security, a financial vehicle that has been giving returns of around 7 to 10% a year for the last 100 years or something ridiculous like that. This is a place in which you would feel comfortable investing, long-term investing, putting your hard-earned money and hoping to grow it in a safer way for your retirement, right? This is a place that is good for investing, but not very good for trading. 7 to 10% a year is good, especially if you have large capital. But at the end of the day, us as traders are trying to build accounts, are trying to grow a $1,000 account to 10,000. For that, you need 100% moves. You need 15% moves, 20% moves, ideally per day, right? So long-term investing is more for passive income, for retirement, for bigger picture ideas, for emerging industries, so on and so forth. This is something that, of course, I would recommend for you to do, especially if you're younger, and take advantage of compound interest. This is outside of our scope on this class, so I'm not going to be talking about too much about what this is, but hopefully you are aware of what compounding interest is and the magic that it can give you. If you are in your 20s and you invest around $300 to $500 in a well-diversified, with a good track record, mutual fund or ETF like this SPY, let's say, it is not financial advice, it's just an example. Thanks to compound interest, that money after 10, 20, 30 years, let's say from ages 20 to 50, and you want to retire at 50, that money will grow to be a portfolio of over $1 million. And with over $1 million, you can easily retire with that, right? If you invest $1,000 a month, you can grow that account to be $2 million, right? So on and so forth. And all the payments that it's going to require, let's say the $500 per month for 30 years, it might come to be like $200,000, which is still not nothing. Remember, 30 years is a long period. But you being able to grow $800,000 worth of interest just from putting aside $200,000. And of course, you don't put $200,000 aside right away. You do it monthly. That is right there the power of compound interest and how you can literally become a millionaire by just investing, especially at an early age. The earlier you invest, the more powerful and exponential compound interest becomes. All right. The second strategy, how to make money out of the markets, is by investing in dividend stocks. Dividend stocks is another form of long-term investing that focuses on collecting payouts based on a percentage of the business profits. This is more of the typical what would you expect whenever you're a business owner. When you're a business owner, whenever profit is made, you expect a little share of that to come your way, right? The difference between long-term investing and dividend stocks, I mean, it's the same thing, but it's just the financial vehicle that you pick is slightly different. A stock that pays out dividends usually will not appreciate that much in price. Okay, and that's why they pay dividends. It's the incentive, as in why you should invest in a company like this. For example, Industries that are no longer exciting, industries that are no longer growing, banks, the bank industry, the financial industry. Let's say a stock like Bank of America. Bank of America is not going bankrupt anytime soon, but it's also not going to appreciate and grow in value because it's not this exciting business. It's just a simply old-fashioned established company, right? Usually banks like Bank of America pay out dividends. And the idea behind it is if you invest in Bank of America and give your money to Bank of America and in exchange receive a few shares of that company, since the price is not going anywhere, if you look at the Bank of America chart, it's pretty much going sideways. What they will give you in return is payouts. These payouts are usually every quarter, and it's a percentage of the profits the company is making that year. And how much they pay you out depends on how many shares you're holding. Okay, and this allows you to get some cash flow, right? Allows you to get some cash flow to spend monthly for your bills. Unlike long-term investing on a stock that doesn't pay dividends, the only way you generate cash flow is by you selling the security. Okay, but dividend stocks gives you cash flow every 4 months usually. It's kind of like having an owning property, owning real estate. You get paid rent, right? You get cash. The good thing about real estate is that is the best of both worlds. It will appreciate in value, and they will also give you payouts. All right. Now, this is why we're here: trading. Let's get a little bit away from investing and long-term holding, and let's talk about trading. So, swing trading is a trading strategy or trading style that attempts to capitalize in short-term price changes. Okay. And the difference between day trading and swing trading is that day trading, as the word implies, a trade lasts less than 1 day, which means you buy and sell a security within the same day, within the same trading session. Day trading is a trading style that heavily relies on technical analysis, and the sole goal is to capitalize in quick spikes or drops in stock price within the same day. All right. For example, swing trading could be a bigger picture trade idea. Still not long-term investing, but a bigger picture trade idea. For example, not so long ago, I took a very successful swing trade on ticker symbol DJT. DJT is one of Donald Trump's companies. And I don't want to get political here. Whether if you like or hate Donald Trump, I could care less. I couldn't care less. Like, it doesn't matter. I'm not saying that I like or dislike Donald Trump. Anyways, I'm just saying I'm an objective trader that once I see opportunity, I just put myself in front of that opportunity to hopefully make some money. So the trade idea behind this swing trade was Donald Trump is having a very successful rally. He's having a very successful media campaign. It looks like after Elon Musk joining his party and helping him promote, he is very likely to become the next US president. And this was during the 2025 elections. I don't know when are you watching this video. Well, the elections were 2024 at the end of it. But anyways, it looked to me there was a very high chance for him to win the election. So what did I do? I went ahead and bought the stock DJT. I bought it at $12. A few months go by. Of course, I was 100% correct. And Donald Trump became the next US president, for better or for worse. Again, I don't care. I'm not saying anything. But the security jumped in price all the way up to almost $40 per share. All right. That gave me a big swing trade, a big profitable swing trade. But again, the concept behind here was I was holding for a bigger picture trade. I didn't buy and sell the same day. On the other hand, when it comes to day trades, I might look at a stock that is spiking up right now, trading at $5, and look to sell it at $5 with 10 cents. And hopefully with enough shares, make some money with this 10 cents worth of profit, right? That profit, let's say if I'm trading with 1,000 shares, 10 cents all of a sudden goes from being 10 cents, which is nothing, to now being $100. What if I'm trading with 10,000 shares? Those 10 cents, which most traders would think as insignificant, which is why this strategy is very fresh and new and not a lot of people are utilizing it, is because people would think, well, buying from 5 to 5.10 is nothing. I need to buy a stock from 5 and then hold it all the way up to $10 to make $5 a share. But no, now we are showing you that you can make money with micro movements. If you buy 10,000 shares at 5 and sell it at 5 with 10 cents, you make $1,000. What if you take that trade a few times in a day? all of a sudden you're living off the markets, right? All right. How do you go about buying this stock? You kind of understand what somewhat the stock market is, how to make money, kinda, and you're excited now. You want to buy some stocks. All right. Let me change to this slide. This slide is actually updated. The other one was still showing TD Ameritrade, made rest in peace. TD Ameritrade was a broker that was bought out by Charles Schwab. So TD Ameritrade doesn't exist anymore. But anyways, so how do you actually buy a stock? Well, you can physically call Elon Musk and tell him, hey, I want to buy a few shares of Tesla. Or you can call Jeff Bezos and tell him I want to buy a few stocks of Amazon. But instead, you need to find an intermediary that is certified that will do this transaction for you. Those intermediaries are called brokers. A broker is simply a middleman between you and the stock market. This is the individual that will look out for the shares you want, take your money, and make that exchange. Give you back the shares, and then give the money back to the company that is raising the money or selling the shares, or maybe another trader that is selling those shares, right? So these brokers is where you would open an account. They usually look like bank accounts. Some of them are banks themselves. And here's where you would buy and sell, look up for stocks, pull up their fundamentals, pull up their charts, and so on and so forth. So American brokers, here's a list of the brokers I've tried, and I would say the ones I would recommend. TradeStation is my favorite, at least for now. Charles Schwab is one of my favorites as well. Lightspeed is very good, but it's not free commission. So TradeStation is free commission, E-Trade is free commission, Charles Schwab is free commission, TradeZero is free commission, Webull is free commission. You can still implement the hyper-scalping strategy with a paid commission broker, but you gotta make sure that you are a little more selective and understand a ECN rebates strategy. Of course, we go into deep detail of what that means and how to survive a paid commission broker. Let's say you don't have access to a free commission broker within our program. So you still can hyper-scalp, but you have to be aware of how to get paid to trade, how to gain and collect rebates so that at the end of the day, those rebates can cancel out your commissions. But anyways, if you have access to a free commission broker, that's even better, because we are going to be trading a lot every day. And the more you trade, the more commissions you would rack up, and that can make it very expensive. But if it's free commission, then it's free, right? So TradeStation is free, E-Trade is free, Lightspeed is not free, but it's very good software, especially for specific strategies that require speed over free commission. For example, I also took my DJT swing trade on Lightspeed. Who cares if I'm paying commission on a trade that is going to last 3-4 months, right? Webull free commission, TradeZero free commission, Interactive Brokers free commission, Charles Schwab free commission as well. All right. International brokers outside of the US, TD Ameritrade used to accept international customers. Also, Charles Schwab accepts your international customers. Lightspeed accepts international customers. Let's say you're in Europe, you are in Latin America, they usually accept international customers. CMEG accepts international customers. TradeZero, you gotta make sure you are in the international branch. Interactive Brokers, same thing. You gotta make sure to be in the international branch or Canadian branch if you're Canadian. And then ZIMTRA, this is the one I probably would recommend if you're not an American and don't have access to these. They are very good. They don't have PDT, which brings me to my next subject, PDT. What the hell is that? But if you were an international and have $25,000, I would recommend one of these free commission ones. All right, so PDT rule. What the hell is this? I just mentioned it. 25,000 PDT rule. Pattern Day Trade Rule, PDT, is a US regulatory designation for an investor or trader that executes 4 or more margin day trades within a 5-day business period. Pattern Day Trader Rule is designated to protect the small investor and prevent them from day trading, overtrading, or simply gambling in the markets. Because of PDT, investor traders can only day trade 1 to 3 times per 5 business days. Of course, this won't work because we are trading hundreds of times per day. How am I supposed to trade 3 times per week? It's kind of ridiculous. Again, in our program, we have a few strategies on how to do some workarounds within this law, within this rule, so you can actually day trade more than 3 times per 5 business days, assuming you don't have $25,000. If you do have $25,000, well, this rule won't apply to you. But still, keep in mind that the fact that you do have $25,000 puts you in a position of even higher risk, because as a beginner trader, you are most likely going to lose a lot. So if you're starting with a big account, you're most likely going to lose a lot of it. So be very careful. All right. Overcoming PDT, having an account over 25K, opening an account outside of the US, or trading with a cash account. Trading with a cash account gets a little complex because you have to split your capital within 2 days, so that when the transactions clear out, which is usually after 1 business day, you have enough capital back to keep on trading. If you are in a cash account, you don't have margin, so you won't be able to trade, infinite amount of times, because your cash will run out. And again, it's a little more complicated outside of the scope of the class, but there is ways to go around the PDT rule. All right, so out of all the type of venues of profiting in the market, why do we choose day trading? In comparison to investing, with day trading, you don't need as much capital, which means, as I was telling you, SPY, Netflix, Disney, these big companies, they might grow 3, 4, 5, 6% per year, which is great. If you already have millions of dollars invested and you get a nice 10%, 6% return per year, that's awesome. But what if you have a small account? What if you only have $10,000, $20,000, $25,000? 3% is better than nothing, but we are looking to grow that account a little bit faster, right? Which is why we're going to be focusing on trading cheaper stocks. These companies like Disney, Amazon, and Netflix, they already came and went. They already had their hooray time. They already went from a small company into a massive empire, right? And I'm trying to build the castle here. They already went from nothing to everything. They already went from zero to hero. So although they make good investment vehicles, they don't make good places for you to day trade, because you want to be catching and trading companies that are still small, that are still somewhat obscure, but that means that they still have massive potential for them to grow exponentially. And here's why we trade cheaper stocks. Cheaper stocks have the potential of moving 50%, 100%, 200, 300, sometimes 1000% in one day. One day. And I'm not making this up. This happens, and it happens very often. Here's the place where traders are looking to grow small accounts. And this is the arena in the market that we focus in, right? At least for us day traders, hyper-scalping. If you're a long-term investor, of course, that's a different story. If successful, you can gain financial freedom and freedom of your time, right? That's the whole point with trading. You want to make this your career. You want to make a living out of the markets. So day trading is, as we discussed, is a trading technique that capitalizes in quick spikes or drops in stock prices. Unlike swing trading, day trading opens and closes a position within the same day. The whole idea behind trading is to buy cheap and sell expensive. Buy low, sell high. Day trading heavily relies on technical indicators and analysis to find entries and exits. These indicators are the craziness that you see within some trading offices, in which you see 10 monitors, you see all kinds of colors, all kinds of lines, all kinds of tools, all kinds of indicators. These are the indicators technical analysts utilize to find these spikes in price, to hopefully make money out of those intraday volatile moves. Right? What we utilize also as hyper scalpers is the same tools: trend lines, support and resistance, candlesticks, patterns, candlestick patterns, MACD, RSI, VWAP. These are indicators that allow us to predict what the hell is going to happen in the next 5 seconds, in the next 10 seconds, in the next few minutes, right? Which is, of course, extremely paramount for us day traders. Day trading can be highly profitable, as large sums of money can be generated from small changes in price, what I was telling you earlier. Day trading is a high risk, high reward venture, so good risk management practices are a must. So going back to the example, imagine you bought 10,000 shares at a stock that is priced at $1, and it goes from $1 to $1.10. You can make $1,000 in virtually no time, 10, 30 seconds, right? But just as how fast you can make $1,000 if you don't know what you're doing. And like I said, if you're a beginner trader, you will most likely get the trade wrong. You will most likely buy at the wrong time. You will most likely buy the wrong stock itself. And if you miss and if you screw up, in those same 30 seconds, you can lose $1,000. This is why risk management is a must for you to be a proficient, profitable trader. We'll talk about all of our risk management strategies a little bit more during this class, but most thoroughly in our day trading program. Another thing you gotta know, especially if you're a very beginner, the difference between long and short. So in the markets, most people believe you only make money if you buy a stock for cheap, then the stock price increases and then you make profit because, let's say you bought a stock at $5, it is now worth $6. You made $1, right? That's how you make money in the markets. For whether if you're investing, swing trading, day trading, this is how most people think you make money on the market. But there's actually a dark world, like an inverse world, in which you can also make money if the price of the stock comes down. You're essentially betting against the company. You're betting that the price of this stock will drop. And if you're right, you can make money. That is creating a short position. And the typical position that when you make money when the stock goes up is a long position. To be long, a position means that a trader has bought and is now holding a positive amount of shares. When a trader is long, the stock needs to increase in value. It needs to go up for the holder to make some profit. The inverse, to be short. A position means that a trader has sold a stock and it's holding a negative amount of shares. It's a little hard to comprehend. How do you sell shares without even having them to begin with? And again, this goes outside of the scope of this masterclass, but just think of it as a negative bet. I am betting against the stock going down. You later on understand how the technicals of that works. But for now, it's just a negative bet. If the stock goes down, you make money. This is a technique that capitalizes when an investor believes the price of a stock will go down. For example, when would you bet against a company? You will bet against a company if you think the company is overvalued, if you don't believe in the mission, if you think it's overpriced, if you think, for example, not so long ago, Donald Trump and Elon Musk went from being best friends to being worst enemies. And because of that, Donald Trump passed a bill that was removing a lot of incentives for Americans to buy electrical vehicles. It was removing a lot of income, electrical vehicles, a lot of income that businesses producing electrical vehicles were gaining, right? These are like, environmental types of incentives, right? Go green, go electric, all that stuff. Well, Donald Trump removed a lot of those things, and that directly affected Elon Musk because he's the owner of Tesla, obviously, and Tesla manufactures electrical vehicles, right? So the moment a trader sees this type of headline, sees this type of breaking news, you can initiate a short position on Tesla. Let's say Tesla right here was trading at $300 per share. You create a short position, and let's say the stock drops to $200 per share. Sorry. Let's say it drops to $200 per share. You make the difference. You make $100, right? Just like that, you're making money out of the inverse. So that is going short, right? That's the difference between going short and going long. All right, so how do you make money out of trading? Let's actually talk about an example of how do you profit off of trading, especially to the long side. Us as hyper-scalpers are 95% of the time going long. So we are betting that the stock price is going to climb up, all right? So keep that in mind throughout this entire mastermind. Utilizing technical analysis and MAU strategies, Marcelo buys 1,000 shares of stock ABC at a price of $4.50. After 2 minutes, Marcelo catches a quick spike. Let's say my trade plan was correct. and the stock actually jumped 50 cents in my favor. Then I went ahead and sold those 1,000 shares. Let me move myself here. I sold those 1,000 shares for a profit of 50 cents per share, right? But I didn't not only make 50 cents, because remember, I bought 1,000 shares to begin with. So 1,000 multiplies times 50 cents. I made $500 worth of profit, right? This was the trade idea. And we're going to get into patterns and pattern recognition here in a bit. But for now, this is the trade idea. I saw that the price, after a spike from, let's say, $4, it went to $4.50. And I like the fact that it was consolidating above $4.50, starting to think a little bit more technically. There's support here. The breaking news are good. I think we might see continuation. I go ahead and open a position, buy 1,000 shares. We do get that spike, and I sell for 50 cents a profit. But what would have happened if, instead of us rallying higher, we failed and we started to step down? What would you do? Would you hold and hope? Would you hold until the stock price goes from 4 to 0? What would you do? Well, you would put risk management strategies in place. Risk management. If the ABC share price crossed under 425, Marcelo would have closed the position, sold the 1,000 shares, and take a $250 loss, right? Usually as traders, we are aiming to make more when we win than to lose when we lose. For example, if I am risking $100, at the very least, this trade right here has to have the potential of going up $200, $300 even better, $400 even better, right? So we are always capping our losses. If the trade immediately doesn't go the way we thought it was going to go, we cut our losses. And the idea is that every time we risk $1, we could make, every time we risk $1, we can make $2, right? This is what we call a profit-loss ratio. We're going to talk about this a little more. And what that means is that since you are winning double or triple every time you are correct in a trade, even if you're not right 100% of the time, which you won't be, losing trades are inevitable. So stop focusing on not trying to lose ever. Instead, focus on losing little when you lose and winning big when you win, right? When you have a profit factor like this, winning and becoming a profitable trader becomes a little bit easier, because even if you only have an accuracy of 30%, let's say you suck at picking good stocks, you suck at picking good patterns, and you're only accurate 33% of the time. Well, if you have a profit factor that is positive, you will make money in the long run. And not with 33% accuracy, maybe with 40%. With 33% accuracy, you would be break even. All right, now, support and resistance. Again, this is very surface level. I'm going to say this a million times throughout this class. We have full classes on support, how to find good support levels, what do they mean, why are people buying there, how to find good resistance level, how to trade against resistance, how to buy against support. All that good stuff is in our program. But for now, it's just very basics, all right? So in trading, support refers to a price level a security does not drop under. These levels where buyers are present, defending the price. This is the basic concept of demand and supply. Usually these levels coincide with the historical prices that were once also respected. This is the core of technical analysis. You have a stock in front of you. You have a chart that goes months and months in the past, and you can see how did the price of that stock behaved around certain levels. Was 3 a level of support? Meaning when the stock was dropping from 4 to 3, did we see buyers coming in? Did we see the stock holding above 3? That becomes support, right? All the traders that are trading today take note of that, and it becomes a self-fulfilling prophecy, because in the past 3 was support. Now it's also support because all of the traders that are trading today saw that and they are buying against 3. At the end of the day, you got to keep in mind that whether if a stock price goes up or down is completely correlated with how much people are buying and how much people are selling. If there's an influx in buying, the stock price will go up. If there's an influx in selling and most people are selling, a stock price will come down. This is basic economics, basics, demand and supply. The more demand there is, the higher the prices of a stock will be. The more supply, which is usually thought of as selling, the more the stock will drop. And what support is trying to tell you here is that for whatever reason, let's say this is the price level of 3, right? For whatever reason, there are people defending the price here. There are people buying against 3, and that itself makes the support level. So as you can see, circled here in purple, in blue, sorry, we have some support levels, and circled here in red, we have some resistance level. And what is resistance? Resistance is a price level in which selling is so strong. There's so many people selling there that the security can cross up over it. Cannot. This should say cannot. So the selling is so strong, the security cannot cross over that level, right? These are barriers in which the supply of seller is bigger than demand of buying. Something incredibly important that you are going to take forever in your trading career is that when the resistance level is broken, the level turns into support, right? Which is exactly what you're seeing here. We had resistance right here. Let's say this was a price level of 2. For whatever reason, the stock was unable to climb up over 2, whether there was a lot of banks selling at that price, whether it was because fundamental analysts thought that given the intrinsic value of this company, it should never be worth more than $2. And because of that, people knew that and nobody held it over 2 and everybody sold it at 2, right? For whatever reason, there was a higher level of supply, a higher level of sellers at that zone. And that itself created the resistance, right? And that might have happened a few months back, but because we are trading today and we have historical data, we can note that level for today's trading, right? But what happens when we break out of it, like we did right here? Once we come back down and test 2, usually, and this is not always, but most of the time, that level is now transformed into support. And that is good for us because we as long bias traders, we like to buy at places in which risk is minimal. You're pretty much now buying at the new floor. You're buying just above support. And you have opportunity to climb up higher because you just broke out of that resistance. So that is a very popular strategy that you'll learn here in the program. Buying against support gives you low risk and high reward potential, right? That's why you care about these levels. That's why you want to know where support is. And under the same token, you want to know where resistance is to know where to not buy. If I know there's resistance here at 3, I won't be buying at 3. Why? Because I don't want to buy in for the stock to immediately reverse. I don't want to buy in for the stock to immediately drop in price. I'll wait until that level of resistance is broken. And as you can see, we broke it right here and we came back down. We tested a few times and that level indeed was now turned into support, right? Okay. So those are the basics there of support and resistance. All right. Now let's talk about candlesticks and trading patterns. So far, we've only seen line charts. And this is probably what you are mostly used to looking. If you Google, Tesla, Apple, whatever company you want on the internet, usually these stocks are reflecting the time and price with a line chart. This is a very basic type of chart. It's just a line that it simply tells you 2 points of data. This is time. This is a chart, by the way. This is time, and then this is price. At this time, this stock was trading at this price. It just tells you time and price. It's the only two metrics that it tells you. Right? Very basic. It's a line chart. But us as traders, we are going to be using Japanese candlesticks. They look like this, right? You've probably seen them. They look fancier. They are a little bit harder to read, but they for sure give you more information that can become signals for you to buy and sell a given stock. All right. These candlesticks also create the trading patterns. All right. So this is how a candlestick looks like. Unlike a line that only tells you time and price, candlestick tells you more in a deeper level of what happened during that time and price. It tells you 4 more points of data. If it's a green candle, it tells you at what price it opened. And remember, this is a chart, right? This is price and this is time. It tells you at what price. Oh, by the way, each candle opens and closes based off of time. Within the trading world, within the trading graphics, you can choose time frames. You can choose a 1 minute chart, or you can choose a 1 hour chart, which means if you pick a 1 minute chart, every candle that you see within that chart will be composed of 1 minute worth of data. So each candle is 1 minute. So a candle opens, right? Imagine the chart, candles are opening, right? As time is going by. When a candle opens, that means that a fresh minute is just starting. The candle will be able to dance around for 1 minute. And the dancing around is based off of the buying and selling that is happening live. Are people buying? Are people selling? If people are buying, the candle goes up. If people are selling, the candle goes down, so on and so forth. And once that minute is done, a new candle opens, right? Then this candle dances again and it creates a new pattern. Then it closes. Then another candle opens. This candle opens again and then it closes, right? So keep that in mind. We usually, as hyper scalpers, we are trading so quickly that we most of the time are using 1 minute charts, also 1 minute candles. All right, so if it's a green candle, it opens. This is the price of where it opens. Let's say this price is $3. It opened at $3. It went all the way down to $2. This is the lowest point the candle went while it was dancing. Then it climbed all the way up to $4. $4 a share, right? Which is marking this data point here is the highest point in which the candle went. And it came back down and closed at $3.90, let's say. This is the kind of like the shape the candle gave us. And why does the shape matter? Well, the shape matters because the shape itself tells a story. It tells the dance between buyers and sellers within that 1 minute. And within candlestick patterns, you can literally make buying and sell signals from the shape those candles form. And then to make it even more complex, you can make signals and full-on patterns out of a series of candlesticks with different shapes. All right, but again, that is more advanced and we won't be talking about too much of that here in this masterclass. But of course, we do a deep dive on all of that stuff in our program. All right, so this is for a green candle. For a red candle, it's pretty much the opposite. It opens at this price. It hits a low of the ending point of that wick. It hits a high of that ending point of that wick. And then it closes at the end of the body of that candle, right? And I hope you can start to see how that matters for us day traders. Because instead of just seeing a line, now you have a full story that tells you how buyers and sellers reacted to that level. For example, what if a candle, after doing the 1 minute dance, would have closed like this? What does that tell you? Well, you as a beginner trader probably tells you nothing. Maybe tells you that it looks like a hammer. And you will be right. This is actually called a hammer candle. But what does that mean? What does that mean? It means that there was so much buying down here. So this is what it means. It means that the candle opened. Let's say it opened at 3, right? Then it dropped all the way down to 2. But most likely 2 could have been a support level. And there were so many people buying at 2 that it immediately and extremely bounced all the way up back to 3, creating this elongated wick, right? This hammer shape. And that for us is a buying signal because it tells me during that volatility within that 1 minute, after the stock dropped, there was so much demand for buying down there that it bounced so hard all the way up to 4 and it closed at 4, right? So instead of just being a line that tells you nothing, it is a full story. We opened at 3, we dropped at 2. There was so much buying at 2 that we created this huge bottoming tail, this huge hammer candle, and then we closed strongly all the way up to 4. That can be a buying signal, right? And that's the beauty of candlesticks. So even though each candlestick tells a story itself, there's also multi-candle patterns. And here is like the more typical patterns that you might be used to thinking. The bull flags, the ABCD patterns, the 3-bar plays, all these. We have many patterns to go over. But again, I'm just going to show you a few examples. The idea is that you're going to start trading tomorrow from this masterclass. It's just that you get a little bit of a taste of what trading is about, what the hyper-scalping strategy is about, and how do we trade here, and what you should expect if you do decide to join the program. All right, so this right here is a multi-candlestick pattern called the bull flag or the pullback. If you want to think it in terms of line chart, this is how it would look. We have a stock climbing up in price. It hits its high and it does a retracement. Then it bounces, then it comes back down, and then it breaks and it makes a new high, right? This is how this would look in a line chart, right? But remember, now we want to know the story of every single candle, right? So the bull flag or the pullback is a bullish candlestick pattern that is composed of a surge in price, pull, followed by a consolidation, pull. This is a continuation pattern. This is a pattern that we, as long bias traders, like to trade because it tells us that, one, you found a stock that's going straight up, but where do you buy it? Well, you wait for a place in which you can manage your risk. You wait for a retracement. You wait for the stock to become a little cheaper. You jump on that, you buy on that consolidation, and then the hope is that the pattern continues to higher levels. And then you make profit as it climbs higher and higher and higher. When we say bullish, that means, all right, so you know how I was talking about long and short? People that are long are people that are betting for the stock price to climb up. People that are short are people that are betting for the price to drop down. It's the same concept. If you are a bull or bullish, you are betting for the stock price to climb higher. If you are a bear or bearish, you are betting for the stock to drop lower. All right, next pattern, the ABCD pattern. This is a pattern, the W pattern is a bullish multiple candlestick pattern that is composed of a surge in price, right? Here's the surge in price. Then a longer consolidation that forms a W formation that indicates the stock is holding up levels and looking to go higher. So you can see here's the W formation, right? We won't go into the technicals about why the W is formed and what does it mean, but these are very common and popular patterns that traders like us trade. And, you can execute off of these patterns. Another very popular one, the 3-bar play. This is a setup, a bullish candlestick pattern consisting of a first initial spike right here, which is one green candle, a brief tight red candle, right? Candle number 2, and a third surging green candle, candle number 3, that closes over the candle number 2, right? This would be your buying signal. The moment this candle is breaking over the high of the red candle, that will be where you buy. And then you would manage your risk at the bottom of that red candle. If the stock drops after you buy underneath this level, you would sell for a smaller loss. Excuse me. And this provides a quick entry to a parabolic stock. So usually, when you're trading a stock that is so incredibly hot, that is going straight up, that is not really giving you full pullbacks, you can do two things. You either miss the entire move, or you jump in on a briefer, quicker pattern, just like this one. This is a pattern that allows you to jump in on a stock that is seeing massive demand of buying. For example, when Johnson & Johnson and all these companies trying to figure out a vaccine for COVID, when they finally released the news that they had developed the vaccine, so much demand came into these stocks that they just started going straight up in price. As a trader, you want to jump on that volatility, right? But you still want to manage your risk. But if you say to yourself, I'm going to wait for a bull flag, I'm going to wait for a full retracement with, let's say, 3-4 red candles of pullback. If you wait for all of that, you might miss the entire move. The stock is so strong and with such demand right now that it might just go straight up to 100 and not give any pullbacks. But it might give these briefer, quicker pullbacks. And that right there can be your opportunity to still jump in. All right. Now, let's talk about market caps. So within the stock market, there are subsectors of stocks, of businesses, depending on how large the value of the stock is, depending on how big the company is, they would be divided into these subsectors: small cap, mid cap, large cap. A very common misconception is that people believe the higher the price of a stock, the more valuable the company is. And most of the time that is correct, but is wrong thinking. For you to know the true value of a company in terms of money, you would have to use this formula. You would multiply all the shares that are out there in the market, and you can find this in Yahoo Finance. In Apple, how many shares has Apple sold? Apple has, let's say, 1 billion shares out of the open market, right? Or Tesla has 2 billion shares out of the open market. That's how many shares it sold. Then you multiply that number of shares times the price of the stock at that time, right? That is going to give you the true value, the true market value of this company. And why people sometimes get it wrong, thinking that the more expensive the stock, the better quality the company, or the bigger the value, is like this. If there's a stock trading at $1,000 per stock, but let's say there's only 100,000 shares out on the open market, a beginner trader would think that this stock is worth more than a stock that is only trading at $100 instead of 1,000, is only trading at 100, but has a 10 billion shares out in the open market, right? Obviously, the one that is $100 in this case is worth more. It has a bigger market value after running this formula than the stock that is technically worth 1,000, but it only has 100,000 shares. All right. So because of market cap, we form these sectors in the company. Small cap is a section of companies in the market that have a total market value of 250 million to 2 billion, right? These are the smaller companies that we like trading. Most of our hyper-scalping strategy, day trading strategies are based on small cap companies. Why? Because they're still small. And these numbers are small. I know for a single person, there's nothing small about this, but for bigger companies in the stock market, this is what's considered small. And why we trade small companies is because we want to buy Apple before it even becomes Apple. We want to buy Microsoft before it becomes Microsoft. We want to buy Disney before it becomes Disney. We want to buy small companies that have huge amount of potential to grow exponentially, because there is where we see 100% moves in one day, 200% return in one day, 300% return in one day, right? Small caps are high risk, high reward because, if you don't have an established name like Apple, Microsoft, and Disney, a company can also fail. They can go bankrupt and you can lose just as fast as you can make money. But aside that, we focus on this area in the market because one, the stocks are cheaper there because they have smaller market values, but also because they have the most potential to move along. And since we are not investing, we're only trading, we care about that daily intraday volatility. If you're investing though, you're better off focusing on larger caps. People that have companies that have a track record and have built a empire already, because that way your money is going to be safer. Mid cap is a section of companies in the market that have a total market value of 2 billion to 10 billion. And large cap is a group of companies in the market that have a total market value of 10 billion and beyond, right? So these are the type of caps, market caps. Caps stands for capitalization, market capitalization, right? Now, I briefly mentioned how hard trading is. I briefly mentioned how risky trading in small caps is. But now I'm going to remind you that trading is a full-on career. If you're trying to get rich quick, if you think that trading is a side hustle that only takes a few minutes a day, a few hours a day, you are mistaken. This is a full-on career, like trying to become a doctor, like trying to become a pilot, like trying to become a open brain surgeon. This is something that will take months, if not years, to master. And not a lot of people come into the markets with that mindset. And because of that, they risk all their money, all their savings in the first few days, and they blow out and they are out of the markets forever, right? So with that in mind, I'm telling you, you are most likely going to fail epically, at the very least in the beginning. So with that in mind, do two things. Put risk money aside. Put risk money, money that if you do lose it, which you most likely will lose it, that if that happens, when it does happen, because it might happen, your life is not affected. Your livelihood is not affected. Your emergency fund is not affected. You no longer have money for college, or you no longer have money for retirement, right? This is risk money. Keep in mind, you most likely will lose it. So make a decision of an amount that you are comfortable with losing, okay? Or even better, trade in a simulator. I'm going to talk about what a simulator is in our next slide here. But anyways, to get started, you will need risk money. Risk money, money that does not affect your livelihood if you lose it. This will be the initial investment that you will deposit in your trading account in order to get started. Learning to day trade is not an easy task. In fact, 90% of day traders will fail, and they do fail. And I've been trading for almost a decade, and I've seen people come and go time and time again. So don't think you're the one. Don't get too cocky, right? Follow these steps that I'm telling you. Put aside risk money. Follow the blueprint. Don't run before you don't even know how to walk. Take it very slow, because the markets are merciless, right? This is part of the reason why my community is called that, merciless markets. The moment you screw up, the moment you fumble, you're going to be wiped out completely, all right? So risk money, what is going to be your risk money? Number two, you have to implement our risk management strategies so you can mitigate and do damage control in terms of losses. And lastly, trading simulators. If you're a beginner trader, you've never traded before, and you know that the odds are against you, why would you risk your hard-earned money if you can trade in a fake environment, in a simulator? A simulator is also known as paper trading. It's pretty much a platform that will give you all the tools you would ever need to become a proficient trader. You're going to learn how to find stocks to trade, how to read fundamentals and technicals, how to read charts, how to read indicators, when to buy, when to sell. You're going to be able to trade the live markets with the live prices every day. But instead of risking real money, you'll be risking fake money. You'll be risking monopoly money, right? That's the difference. It's a simulated environment in which you first test your skills. You first learn. You first see if you have the aptitudes, if you have the time, if you have the strategy, if you have what it takes to be a profitable trader. And if you do get that, then you can start trading with a real account, right? Or there's people that like trading with real accounts right away, but with small amounts of risk, so that they get the real deal right away, right? There's that argument that I hear a lot is, all right, I'm not going to trade in a simulator, but at the very least, trade with very, 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 very small risk. Only risk $10 per trade, $10 per trade, $1 per trade. If you keep it like that, then I guess you can trade with a real account. All right, so keep that in mind. Here in Merciless markets, our priority is for you to lose less. Okay, so If there's anything you can take out of this masterclass, don't trade with real money too soon. Remember that the odds are against you. Remember that the markets are merciless, and trade in a simulator first. Prove that you are profitable in a simulator environment first before putting real money on the line. Imagine if pilots had the ability of flying real planes with hundreds of people in them on day 1, on day 2, on week 1, on week 10. Of course, the success rates of pilots would be 90% of pilots crash and die on their first flight, right? Pilots have to go through simulation. They have to go through certifications. They have to go through academies, through training. Unfortunately, in the markets, there's no such thing as that. The market is the Wild West. If you have enough money, you can open an account tomorrow and start gambling it away. Here at MMU, we're trying to fill in that void. We're trying to fill in that gap. Take our program first. Graduate from it first. And if you, for example, in MMU, in the full-on program, we have a baby steps that we put our students in for them to graduate and essentially start trading with real money. It looks something like this. And I'll give you a brief summary. We put you in a simulator for 3 months or to infinity, assuming that you never grasp the strategy. But assuming that you do grasp the strategy, we want to see at least 3 to 4 months of consistent trading metrics, trading and statistics, a stair-stepping up equity curve within the simulator. Then only then you should graduate and start trading with the real account, but with very low risk, risking $1 per trade, $5 per trade. If you lose 10 trades, if you lose 100 trades, at $1 per trade, it's like that won't destroy your life, right? Then the cycle repeats. Show that you can be a profitable trader within this environment for 3 to 4 months. If that is successful, then you graduate to the next level. Then you can start increasing your risk. You can go from risking $1 to risking $10. From risking $10 to risking $100. From risking $100 to risking $1,000. From risking $1,000 to risking $10,000. This is more close to the level me and some of the other mentors are at, right? But you have to get there, and you have to have that marathon mindset. You won't get rich tomorrow. If you think you'll get rich tomorrow, please don't even try trading. It just will be a disaster. All right? Anyways, that's the rant. Let's carry on. So how do you find stocks to trade? You know a little bit about the market, a little bit about pattern recognition, a little bit about fundamental technical analysis. Now, how do you find these stocks that I keep on saying that have potential of moving up? How do you find them? For that, you'll be using scanners. So scanners is one of the many tools we use as traders, in which we, with a few filters and a few indicators, can code software, and we tell that software to scour the entire US market and to filter through thousands of stocks and to give us a filtered list of stocks that meet our criteria, our hyper-scalping criteria, right? This is going to allow us to filter down from thousands of stocks. Now we only might have a list of 20, 30 stocks. That doesn't mean buy them. That doesn't mean anything. It just means we are getting closer to the point in which we buy and sell, but we haven't gotten there yet, right? With the help of scanners and with the help of these filters and this criteria that we are going to share with you, we can narrow it down to 10, 20 stocks, all right? So these are gap scanners. The criteria within those scanners are that it does have breaking news, it has to have a fundamental reason for it to go higher, it has to have high relative volume, it has to have float, the correct float, it has to have the correct spread, and he has to have the correct percentage gain. These 4 go out of the scope of this masterclass. So I won't go in detail about what they mean and how to scan for them. But that doesn't matter for now, right? This is just big picture stuff. Right, so we code these scanners to filter with these set of criteria. And then the scanner is going to spit out a list like this. All right. And again, these are cheaper stocks, as you can see, because we are trading in the small caps, right? We are trading within that section in the market in which the stock hasn't grown yet exponentially, and we are attempting to catch that growth. And as you can see, we do see that growth very often. 120% return right there, 89% return, 36% return, 19% return. And these are all our filters, right? From here, there's another set of criteria you need to follow to pick these stocks, right? Out of this list, you still want to narrow it down to like 2 or 1 stock. And this is going to take time for you to master. It takes a little bit of intuition, experience. Here's where fundamental and technical analysis comes into play. You would pretty much do fundamental and technical analysis on all of these. And depending on what strategy you're taking, you're going to start canceling some out, right? I don't like the technicals on this one. I don't like the fundamentals on this one. I don't like whatever on this one. And you narrow it down to 2, let's say. Of course, for now, you're going to have me and some of the other mentors here in the community to help you do the heavy lifting. You're going to be able to see me day trade every day live. You're going to be able to see which is my specific watch list. I'm going to give you the 2 or 3 stocks that have the most potential that day. And then not only that, you're going to be able to see me buy and sell. What stock I'm buying, what stock I'm selling, where I'm buying, what patterns, all that, right? But the idea still is that eventually you do it on your own. Eventually you learn how to find stocks to trade yourself. But while you learn, I'm going to be helping you out how to narrow down this list even further. All right. So, and then you create your watch list. You already narrow it down from thousands of stocks to now 20. Now, how do you narrow that down from 20 to 3? And this is where you continue to follow our criteria, breaking news. You have to have volume at least over 1 million shares. You have to have a float under 25 million shares and a percentage gain at the very least over 20%, right? All right. Now, let's take a look at some real examples. So we've gone along a few ways here, right? So first, we utilize scanners to find stocks to trade. Then, utilizing our strategy, utilizing our criteria, we narrowed that list down. Now we only have 20 stocks. Then, we narrow it down to only 3 stocks. Then we narrow it down to only 1 stock. And let's say that stock becomes TOPS for all these reasons. From there, does that mean you buy and sell? No. We still haven't gone there yet. That means that now you wait. Now you practice patience. Now you practice discipline, and you look at the stock. You wait for the stock to give you the patterns, that we'll teach you here. And only once those patterns become in the flesh, in front of you, that's when you can start executing, right? We'll get into the techniques on when to exactly buy and sell, because even within this pattern, there's still a lot of places where you could buy it and sell it. It's still way more narrowed down than having 1,000 shares to pick from and buy from, but still is still broad enough in which you can have a lot of losing trades. So we got to narrow it down even more, right? So you wait for the pattern. Then once the pattern is in front of you, you execute. You buy where you're supposed to buy and you sell where you're supposed to sell. Or you exercise risk management if the trade does go against you. All right, so this is kind of like where the rubber meets the road. And we have actual stocks with actual patterns that we most likely traded. All right, so TOPS, we made it to our watch list and we waited for the first retracement, the first pullback. We bought it and we were selling, taking profit as the stock was continuing higher. All right, here's another 2 examples, another 2 bull flags, another 2 retracements. You can right away see they don't look exactly perfect like a flag would look like, right? This is how real trading looks like. It's not perfect, but it's kind of like the textbook image, but not exactly. Remember, trading is not an exact science. It's more of an art, right? Here's TOPS again. Here's another 1-minute bull flag. You buy within the consolidation, sell for profit. Here's another, here are another 2 bull flags right here. Here's one. As you can see, And here's where we start using a little bit of technical analysis. We had resistance at 10. We broke above it, and guess what? It turned into support, right? So here's where you can have multi-strategy alignment. So you are buying the pattern because it's a pattern, but you're also buying it just above support because you know what was resistance prior is now support, so you have lower risk. And then as you are getting resolution, you start taking profits. Then the second pullback comes along. You trade that as well, right? Here's another very nice looking flag on a different stock that for whatever reason, it was our main stock that day. Here's another nice flag. Here's another setup that we haven't yet discussed. This is the VWAP setup, right? VWAP is this orange line indicator that you see. VWAP is extremely advanced. It's outside of the scope of this class. So we won't even talk about that right now. Here's another kind of like consolidation that we had above VWAP as well. Here is another combination of patterns. So right here we have the first pullback, right? We have this rally. We have the first retracement, right? Right? And we are aligning with the support level of VWAP. VWAP is an indicator that tells us where kind of the average of the stock is. It's a weighted average indicator. And most traders utilize it as support and resistance, but it's coded, the coded and the formula that it utilizes is beyond the scope of this class. But we will talk about that and many more indicators that we use during the program. Here's another nice 1 minute pullback, right? You can see it right there. And here's a nice breakout of this resistance level of 320. Here's a 3-bar play, right? 3-bar play. Not sure what this is. This is not really a pullback. This is more of a VWAP bounce, but we haven't really discussed VWAP yet. But anyways, you get the gist of it, right? Now, what else are we looking at in terms of execution? We're looking at level 2. This is a secondary tool to our charts that tells you real-time quotes. You got to remember that charts are a bit of a delayed indicator. At the end of the day, the chart is a canvas and it's simply painting the historical prices at which this security traded, right? Even if it's like a second delay, 2-second delayed, it's still slightly delayed. It's a delayed indicator. It's kind of like something, it's kind of like looking at your rear view mirror. But this right here, the level 2, is looking at your windshield. It's looking in front of you. This crazy box that you see here, again, I'm not expecting it for you to understand it right now. This would take us like a whole course on just level 2. But think of it as the live quotes. Think of it as you going to a live auction, and the guy is calling out the prices, selling for 138, selling for 138, 139, 137, 138, 139, 140, 141, 142. These are the real prices in real time, and this is what we utilize to execute and to be as precise as possible. But the only thing you got to understand, at least from this slide, is this is the price of the stock, 138, right? This is the price of the stock, at least kind of like the freshest new price, 138. Level 2 is an order book. Think of it as a log. It shows you the record of all the current buyers and the sellers of the security, but it's fluctuating in real time, right? Because it's changing every second. The log is ever changing. So the level 2 is continuously updating to show new orders. Right, so this is the level 2 and is another tool that you utilize alongside charting for us to buy and sell. Now, let's talk a little bit about risk management. So risk management is incredibly important here in trading because, as I said, you are most likely going to lose. In fact, I still lose. Even after trading almost a decade, I still lose and I will continue to lose. Having a losing trade is inevitable, but what you can indeed control is to manage how much you lose, right? And for that, we implement risk management strategies. Within those risk management strategies, we have our profit to loss ratio. Position management profit loss ratio. Profit loss ratio is the average profits of winning trades divided by the average loss of losing trades. The profit loss ratio is a metric that can be used as a benchmark to check your wins versus losses ratio. it can give good insight to how well you are executing and managing your trades. If you average a 2-to-1 win-loss ratio and a 2-to-1 profit-loss ratio, you can see consistency in the markets. And again, we briefly talked about this earlier, but it's the idea that if I am risking $1 in this trade, at the very least, I need to make 2. And you can add zeros to this. If you're risking $10, you got to make 20. If you're risking 100, you got to make 200. If you're risking 1,000, you got to make 2,000. If you're risking 10,000, you got to make 20,000 on your trade. This is the criteria you must implement on every trade you take, so that in the long term, even if you lose more often than you win, because you're winning bigger when you do win and when you are correct, you can still be a profitable trader. And here's an example here of how that looks like. So before you jump in the trade, you have to establish your trade plan. All right, we are seeing a stock that I like. I already did my homework as why I like it. Now I'm waiting for the first pullback, and here is where I will buy. My objective is to only risk, let's say, 50 cents. Is this red area. And because of that, I need to have potential of making at least $1. If more, even better. Right? But what I'm doing is capping my losses. You're making a hypothesis around the pattern that you're seeing and how much money are you willing to risk to see whether if the pattern will resolve how you think it will or not, right? And the idea, again, is you always risk less than how much potential there is for you to make. And I know some traders that have a 3-to-1 profit loss ratio, which means every time they risk $1, they make 3. There's people that have 4-to-1 profit loss ratio. And of course, the better you become as a trader, the better your ratio becomes. Let's use an example of this profit loss ratio. If you buy 1,000 shares of a stock, XYZ, at $2, profit target is going to be 20 cents per share. That means that you're going to be risking half of that. You're going to be risking 10 cents per share. Stock XYZ goes up to 220, you will be up $200. If it drops down to 190, you will be down $100. Something that you got to keep in mind since very early is that a losing trade is not necessarily a bad trade. There's this mistake that a lot of beginner traders fall victim to, thinking making money equals good, making and losing money equals bad. You can have trades that fail that still are excellent trades, that still in the long term will make you money. And under the same token, you can have trades that give you money, but it was as a consequence of bad trading practices. Let's say you didn't follow your plan. Let's say you averaged down. Let's say you went all in and you forgot about risk completely. But for the luck of the draw, you make money. You would think, oh, look, it's a good trade. It's a successful trade. No. That is a green trade, yes, because it netted you money, but is a catastrophe of a behavior. You're going to lose all that money and more in the future if you continue on with that behavior. On the other hand, you can find a losing trade. Let's say in this case, we did lose the $100. But if we follow our plan, if we still executed a profitable strategy, if we sold wherever we were supposed to sell, if we bought wherever we were supposed to buy, and we executed perfectly, that's still a trade you should be happy about, because in trading, you have to care about execution, not whether if the trade was green or red. Obviously, our end goal is to make money, but you cannot carry that mindset or you won't ever trade right? All right. Next, in a long enough sample size, if your profit or loss ratio is 2-to-1 and your accuracy is at the very least 33%, you will be a break-even trader. And this is why the beauty of this risk management strategy of always risking half of what you're looking to make is that you can suck at picking stocks. You can suck at recognizing patterns. You can only be correct 33% of the time, which means out of 100 trades, you will lose all trades except for 33. That's not very good. But if you have a positive profit or loss ratio like the one here, you will be a break-even trader. You won't make money, but you won't lose. And if you start trading and with time and experience, you become and you grow to have a 40% accuracy. A 40% accuracy with a 2-to-1 profit loss ratio makes you small, marginally profitable, but profitable. Okay, so having a positive profit loss ratio kind of like lowers the bar for how accurate you have to be at the beginning. This is why as a trader, you must always respect your stop loss. 1,000 shares at $2 would cost $2,000 worth of cash in your trading account. Every penny the stock comes up and down, you'll be making or losing 10 cents. All right, so within the hyper-scalping strategy and day trading in general, a big edge is for you to be quick, for you to be fast, especially in the hyper-scalping strategy. If you're going to be in and out of trades within seconds, you won't have time to fumble with windows, to fumble clicking around buttons. You won't have time increasing or reducing the share size. You won't have time to type down the ticker that you want to trade. You won't have time to type down at what price you want to buy, at what price you want to sell. In all that time, the trade itself might have came and went, right? So for that, we're going to be utilizing hotkeys. Again, this is a little more advanced for what I want this masterclass to be, but in general, keep in mind that hotkeys are paramount because it allows you to create macros or shortcuts in your keyboard keys. So the second I press this button, I instantly buy 2,000 shares. The second I press this button, I instantly sell. The second I press this button, I instantly buy 3,500 shares, so on and so forth. With the click of a button, I'm in and out, right? Now let's talk about trading styles. Within day trading, within hyper-scalping, there are different types of trading styles. And that usually aligns with the type of person you are, with the personality, and all that. So micro scalpers, also known as hyper scalpers, are the ones that are in and out within seconds. You usually are executing within 1 minute candles, or at the very least within 2 1-minute candles, and you're taking advantage of that micro fluctuation in the price action. You're buying when the stock drops 5 cents, and when it bounces 5 cents, you're selling quickly. You almost never have like a big picture set up in mind. You just know that this stock is strong, you did your due diligence, is going up, and you're capitalizing off of that price action as the stock is jumping up and down, right? This is a hyper scalper style. Very quick trading. A scalper usually is more concerned of bigger picture patterns, how good the bull flag looks, how good VWAP is holding up, whether if we are holding over resistance or support, right? So on and so forth. Because you're going to be holding for minutes at a time. You're going to be buying a stock, you're going to be buying a setup that you really believe in, and then you're going to let it work. You're going to have probably a broader stop and broader profit targets because you're going to be in the trade for minutes at a time. Usually a scalper trades less than a hyper scalper because a scalper has to have higher standards. Because whether if you can jump in and out for 5 cents, that's not enough for a scalper. You want to jump in for 50 cents, for $1, right? And then the longer hold trader, this is a trader that has extreme conviction on the company. This is a trader that is relying a little bit more on fundamental analysis and believes that the news, as in why the stock is moving that day, will give a bigger move than 10 cents, a bigger move than $1. This is a trader that wants to be part of this stock for a few hours within that day, right? The good news about this stock is that when you capture that big winner, you can really have a 10-to-1, a 20-to-1 profit loss ratio. You can have small paper cuts, but when you do find that stock that sticks, you can hold this stock for $1, $5, $10, $20, $30 per share at times, right? But these are different styles. All right, now let's talk a little bit more about real life. How does trading actually look like in real live markets? We've learned about theory, we learned about patterns, we learned about definitions, but now let's translate that to real life. How does that look like? This is where we start implementing the MMU edges. What is a trading edge? A trading edge is an approach, technique, or setup that gives you an advantage over other traders. An edge puts you in a position of higher probabilities of success. This doesn't mean that an edge guarantees 100% profits. 100% of the time, as an edge is measured by averages and large sample size. So an edge is having a strategy that in the long term nets you money. A set of criteria, a set of patterns, a set of techniques, both for buying and selling and risk management, that in the long term nets you money. Given that the market is ever changing and no setup will ever be 100% of the time, a trader must be able to adapt and tweak and improve their edge according to each specific situation. In MMU, we don't believe in buy here, sell here strategy, as trading is an art, not an exact science. So as you see moving forward here, and if you do join us in our program, everything that we teach is high probabilistic techniques, high probabilistic places in which you can buy, places in which you can sell, high probabilistic levels in which you should be utilizing to manage your risk. But it's not always as simple as black and white. It's not always as easy as buy here, sell here, and then you make money. No. Within a pattern, there's many places in which you can buy. And depending on many things, for example, the sympathy of the day, how much money you're up and down on that day, how close or far you are from support, you can implement different buying techniques. Instead of giving you a golden indicator and saying, whenever the moons align, whenever the MACD crosses over, whenever this and that happens, buy religiously without even thinking twice. No, it doesn't work like that. We are discretionary traders, which means there's not an exact moment in time in which a signal would come for you to buy, in which God is going to come down from the clouds and tell you buy. That will never happen. But instead, we prepare you with techniques and high probable places in the chart for you to buy and sell, so that when you are in the live markets, you can make your own decisions of what do you think is the best place for you to buy and sell. All right. So these are the edges. Within our program, we have hundreds of live examples of us executing these patterns, of us buying, of us selling, of us going over and reviewing the trades with you guys, so you can better grasp why we bought, where we bought, why we sold, what we sold, where we sold, and so forth. But right now, it's just like a brief introduction of what the edge looks like. We've been looking at this pattern for this entire session right now, the bull flag pattern. But now, how does this pattern actually translate into us executing the trade? So edge number one is the bull flag. We have about 30 edges in our community of different patterns, different techniques, of different places that you can buy and sell these small cap stocks. But for now, we will just review this one. So entry places. So as I said, there's no golden indicator that the moons have aligned and then you should buy. Within a pattern, there's many places that you can buy. Okay? Within those within them, we have the entry techniques. First candle to make a new high can be one entry technique. The moment this big candle breaks over the high of the previous candle, that could tell you that the pullback is going from resting phase to now turning back up. That could be an entry signal. Another entry signal can be a bottoming tail, a bottoming wick. We were discussing how candlesticks create their own patterns. If you would see a candle like that within the pattern, that could be a buying indicator. Another candle could be the first candle to close green. That could be a buying indicator right here. Another entry could be, assuming that the red candles dropped enough, you're saying, well, I don't want to wait for the green candle. I don't want to wait for the first candle to make a new high. This thing just dropped from $10 to $8. The discount is so big, I'm sure it will bounce. That could be another entry indicator, right? And all of these are high probability entries. Again, there's no one exact entry, like I said, but these techniques are high probable. And the idea is that you learn all the techniques so that you pick and choose the ones that are more adequate to that instance and then execute off of them. And from there, you're going to be implementing, let's talk about stop losses techniques first. How will you manage your risk if this goes south? There's a few techniques, right? You can utilize a breakout or bailout approach. This means that if the moment you buy, the stock is not doing exactly what you expected it to do, you get out of the trade. And you kind of conclude like, I must have read the chart wrong. I must have read level 2 wrong. Maybe the breaking news this company has are not as strong as I thought. I bought, I was expecting for this to happen, right? You bought, you were expecting for higher prices, but instead you bought and the price is just going kind of like sideways. You're like, I don't know what's going on. So you get out, right? Breakout or bailout. If it's not happening right away, you get out. Second risk management technique can be, you see high selling pressure. Well, this is a little bit more advanced. But within the level 2, there's some signals that tells you get out of the way, right? You can set a stop loss underneath a support level. Let's say there's a support level right here of 3. You can set a stop loss underneath that level, right? Or you can set a stop loss underneath the consolidation, right? The bigger the stop loss, the higher the risk, but also the higher the probabilities of the trade working, because you are giving it the most room possible to wiggle around. Sometimes the stocks, after you buy, they jump around. And if your stop is too tight, you might get stopped out and then the stock is going to go without you, right? And then there's another technique here, which is have an arbitrary stop. If you've concluded that you have a target of 30 cents, well, you know what your stop is, right? 15 cents. That stop is arbitrary, which means it doesn't have a lot to do with the actual price action or the actual stock, but instead it has more to do with your own profit to loss ratio on your own profit target. If I'm looking to make 30-cent target, I'm going to only risk 15 cents. And then targets, they can be the high of the consolidation. It can be an arbitrary target of 10, 30 cents. It can be a daily resistance level. And again, this is a little bit more advanced, but we talk about that thoroughly in our program. And here are some examples, right? With live profits. We made $200 on IMRA as we were consolidating on their VWAP, jumping in on this 1 minute pullback, right? Here's another 1 minute pullback. We jumped in at around 340s. And as the stock started rallying, making new highs, 350, 360, 370, you take some profits off the table. Here's another pullback. This is a little bit of a tighter pullback because it only has 2 red candles of retracement. But what do you see here? You see that massive doji, right? That is a buying signal. Here's another tight 1 minute pullback. The tighter the pullback, usually the more explosive the breakout, and so on and so forth. VWAP pullback, break and hold. We haven't discussed VWAP, so I'm not sure if I want to get into this. But at least you can keep here the entry techniques, the profit targets, and the stop loss techniques. If you're already familiar with VWAP, you know that it's an indicator that's very popular. Most institutional traders use it. And because most traders use it, it becomes this self-fulfilling prophecy that when it goes against VWAP, it acts as resistance. When the stock price goes against VWAP. When it goes against VWAP, but now from the other side, as a retest, it acts as support. And you can take a lot of support trades around VWAP. You can take deep trades around VWAP. And then you can see your stop losses underneath VWAP and all that. So again, VWAP is a little bit outside of the scope of this class. So I'm gonna let that go here. But here you go. Here's some examples. All right, moving forward. Trading is extremely risky, extremely difficult, right? Anybody that thinks that they're going to get rich quick, they're going to lose everything. But assuming that you're not one of them, what you want to do is treat trading as a business. What that means is that you're going to have a business plan. You're going to track your month-to-month expenses. You're going to try to get a little better every day. You're going to track your trades. You're going to record your instruments, your graphics, your charts, your level 2, so you can go and review. You're going to invest in education so that you are not a lost fish in this vast ocean. And this doesn't mean joining us. It just means reading about trading. It means seeing how other traders trade and what strategies they're implementing. And reading about fundamental and technical analysis. You have to educate yourself. If you jump in blindly, you're just asking for trouble, right? So you create your own business plan. Imagine that you're going to go to Shark Tank and you're looking to raise money. You have to build a plan that seems sound and that has somewhat good probabilities of it becoming a reality. You go to Shark Tank and saying, hey, I'm going to open a Robinhood account and I'm going to throw 10 grand on it. Can you give me another 10 grand to throw on it? I don't know what I'll be buying. I don't know what sector in the market I'll be trading. I don't know whether if I'll be a long or short bias trader. I don't know if I'll be trading large caps and investing. I don't know if I'm going to be a hyper scalper like Marcelo. I don't know anything. Do you think they're going to give you money? Do you think that is the foundation of a successful plan? Heck no, right? So within your plan, you can literally go ahead and open a Word file, a PDF file, whatever, and write down, answer these questions. What will be my daily trading routine? From every day moving forward, what will be the window in which I will dedicate and put time aside to trade the open market? How much time am I going to dedicate to learn and read and watch recordings of whether it is my own live trading or your own live trading? All right. From there, what strategy am I going to be trading? What sector in the market am I going to be trading in? Am I going to be a hyper scalper? Am I going to be a short seller? Whatever you might want to do, right? Then you're going to start trading and writing down your trading rules. How much money am I willing to risk per day? If I lose this amount, I will stop. How much money am I willing to risk in all this trading journey? $3,000? $5,000? What are going to be my rules? If I catch 3 red trades in a row, I must stop for the day. What is going to be your criteria for you to find stocks to trade? What will be your favorite patterns for you to buy and sell? Right? What is your trading budget? What are all the expenses that come with trading? And then you create your little kind of like business tracker. And let's say on a profitable month, you made $3,500 thanks to the hyper-scalping strategy. But after fees and commissions, you spend $338. After platform fees, most brokers charge a platform fee for you to be able to use their charts, their real-time quotes, all that. What about metrics trackers? If you are tracking your trades, if you're recording your screen, if you're wanting to see the statistics of your 10, 30, 40 sample size worth of trades, how much will that software cost monthly? How much will the chat room cost for you to be in a community like this, for you to be trading alongside other profitable traders? How much scanners would cost, right? You need scanners to scour throughout thousands of stocks in the entire US market. And then how much will your education cost? The good news is that in MMU, we bundle this entire thing up. You don't have to worry about metrics tracker. We have our own, and you can use that one. You don't have to worry about chat room. You can just use ours. You don't have to worry about scanners. We are not only giving you a live scanner so you can see them for yourself, but we're also giving you the watch list, right? We're doing the heavy lifting. These are the stocks that are in play. Or you can do it yourself because you're also going to have access to the MMU scanners. And then, of course, we give you the education. And why you treat it as a business is because a business will most likely fail somewhat at the beginning, but with enough measuring, enough tracking, and enough adjusting, and if you can simply get a little less bad every day and repeat the process for a few months, that's when I think you really have a good chance of becoming a profitable trader. If you treat it as a side hustle, if you have no idea how much money you've lost and made on a given month, of how much money you've spent on scanners and in fees, if you have clues of all that, let me tell you that what you have in front of you is a hobby, a very expensive hobby, okay? If you want to be a profitable trader, you have to treat it as a business. For tracking your trades, you can use the following. You can use software online to track your metrics. As I said, we have built our own. You can for sure use that. You can use OBS. OBS is a software that is free on the internet that allows you to record your screen. It allows you to record your screen to see how you execute it. So then after you can review how you trade it, right? And then you have to track your business of trading, what are your expenses, how much money you made or lost today, so on and so forth. All right, something to keep in mind is the definition of insanity. I've known traders that haven't been successful, that have been trading for 5-10 years, and you would wonder how come you haven't become successful. After 10 years of experience, you must have gotten good at something, right? Well, that's not the case with trading or anything that is hard. Insanity is doing the same thing over and over again and expecting different results. You can make trading your hobby and trade for it for the next 10 years and never become profitable. Why? Because you're just going sideways, like a stock going sideways. You can go sideways for infinity. But as long as you have a slight slope, even if it's minuscule, if you're at the very least getting 1% less dumb every day, as long as your equity curve and your learning curve is sloped, tilted upwards even slightly, even if that means, that the more they slope, the faster you become profitable. But at the very least, if it's sloped by 1% a day, after a year, you will be very close to becoming a profitable trader, if not made there already. Traders must be able to lean in their strengths and ease on their weaknesses to find success. And how do you find these strengths and weaknesses? Is by tracking your business as a trader. All right. Now, let's talk about the merciless markets. Here at MMU, we pride ourselves on being transparent. And I'm going to give you a nice little dose of transparency and explain to you what the stock market really is, but specifically day trading, the world of day trading. You know how there's a lot of taboo around this industry. They think it's gambling. They think it's this very dark thing. It's because it is. It is exactly that and more. In fact, way more than you might think. So why are communities called the merciless markets is because there is truly no mercy in these waters. The moment you slip up, you're going to lose all your money. And remember, the market is a zero-sum game, which means money is not made out of thin air. In fact, the market just moves money from one account into another account. So imagine all the parties that are involved here in the market. Wall Street, big institutions, big banks, institutional traders, which are the professional certified traders, retail traders like ourselves. Everybody out here, algorithms, everybody out here is onto to make money. And how do they make money? Now that you understand that money doesn't come out of thin air, instead it comes from somebody like you onto someone else that knows a little more than you. Their sole job is to make you as poor as possible. Their sole job is to beat you at the game at all costs. And there's billions of dollars being invested in studying retail traders, studying human psychology, so that they can just screw you up as much as they can. Have you ever felt that the second you stop out, the stock bounces, and the second you buy, the stock reverses? Do you think that's coincidence? It is not coincidence at all. It is hundreds of years of mastered parties that know exactly how a failing retail trader thinks, how exactly and where they buy, and they put trades against them. They trade against them to essentially slowly but surely drain their accounts and take their money and put it into their pockets. So be very careful when moving forward in these merciless markets. Everybody's out there to get you, and that's the mentality you have to have, which is why risk management is extremely important if you are to survive as a profitable trader, right? Be extremely careful. And not only the market itself, but the whole industry is borderline a scam. There's fake gurus selling you strategies that don't work. There's fake companies selling you indicators, golden indicators, or trading alerts that don't work. Just be very careful. At the end of the day, you are the commodity, okay? You make money. No, you don't make money. People make money off of you always, okay? It's just like Facebook. It's like whenever everything is too good to be true and everything is free, is because you are the thing being sold and bought, right? Facebook, everything is free, but it's because Facebook is selling your information, is selling your time, is selling your focus and whatever ads you spend time on to other companies. So you are the commodity in the market. We are the commodity. We are the ones being spat out, chewed and spat out often. And unfortunately, this is the way it is, right? If you flinch for a second, if you think you're smarter than everybody else, if you trade with real money too soon, you're going to pay the price of the merciless markets. The truth about the markets, trading and investing is a zero-sum game, which is an economic theory that says that in order for a party to gain and come out ahead, somebody else has to lose. Example number one. This also happens in long-term investing, but is less cutthroat than in day trading. For example, in long-term investing, retirees are able to withdraw yearly interest payments to make a living off of at the expense of new generation of investors that are pouring money into the market. So and that's more of like the cycle of life. Like if money doesn't come out of thin air, how are retirees able to withdraw money? Well, because new generations are learning about investing, they are investing themselves in the market. When enough people invest, aka buy, the prices of those portfolios and the securities within those portfolios are going to keep climbing up in price. As they climb up in price, retirees can sell a few of their shares, a few of their portfolios, a few of their holdings for higher prices, generating money for them to live as they live through retirement. And again, the money is just switching hands from new investors that are investing money and potentially holding for 30 years and retirees selling, right? And getting money from the new people, right? Which is why when we saw the 2020 pandemic, when you get to a place in which newcomers are selling and also retirees are selling, everybody's selling in panic because everybody thought we were going to go into this zombie apocalypse. That's when drops tank. That's when prices drop and they tank a lot, right? If nobody's buying, prices stop going up. Anyways, so that's how the markets are a zero-sum game, more of in a long-term, kind of like cycle of life type way, which is fine. And I guess it's also fine for day trading, but day trading is way, way more cutthroat. Is that how you say it? Cutthroat? In trading, Wall Street, high-frequency trading algorithms, market makers, and brokers profit off of retail traders' losses. Every time you lose as a beginner trader, most likely you are making rich another retail trader. No, another retail trader, no. I guess you could. For example, if you're trading against a short seller, short sellers make money when stock prices drop. And you lose, assuming that you're long by a trader, you lose when stock prices drop, right? So, there's so many parties out there trying to get you. You have to be extremely careful. Don't trust everything you see. People selling you a 100% accuracy golden indicators are probably liars and scammers. Social media scammers asking you for money. I would never ask for money telling you that I'm going to invest for you. I'm going to trade for you. Send me $1,000 and I'm going to trade for you. I would never, ever, ever say that. If anybody trying to impersonate me asks you that, please ban them and report them because that would never be me. There's a lot of pump and dumps, a lot of stocks that are very sketchy that you shouldn't be trading at all. There's algorithms trying to undercut your trades. There's literally algorithms, and this is legal, by the way, somehow. Market makers can have algorithms that the moment they see your buy order go in the market, let's say you buy market order of wherever, they can literally move the market slightly to give you a bad fill, and then they pocket the difference. So this is a little advanced, but I want to tell you anyways. So let's say a stock is trading at $5, right? And because the market makers are playing a different game than we are, it's like playing poker, but they can see all of our cards. Because they pay the brokers for the broker, and then the brokers sell them our information to them, kind of like Facebook. Anyways, they have the ability of see within fractions of a second when we put up orders in our broker. When we say we want to buy this stock at $5, we send in the market order. As our order is flying from your house to the exchange, and this is lightning fast, but as that is happening, market makers that are reacting in fractions and fractions of seconds, they see that order coming. So what do? They themselves buy the stock at $5, right? Where you intended to buy to begin with. Then they pump the stock. They move it up to say $5.10. By the time your order is landing, you are buying now at $5.10 off of them, right? So they bought at $5, whereas you should have gone in to begin with. But while your order was traveling to the exchange, they prop up the stock quick enough for it to say $5.10. Then you get in at $5.10, and they themselves are selling the shares they just bought at $5. They're selling it back to you at $5.10. They just made 10 cents. And for you, it's just like, oh, it's a 10 cents worse fail. So whether if you are making money or not, in both your winning trades and losing trades, the market makers and these algorithms are always making money, right? And here is why free commission brokers exist. How can a broker afford to not charge commission? How are they going to stay afloat? How are they going to stay as a business? Well, if Wall Street comes knocking their door and say, hey, I'm going to pay you billions and billions and billions of dollars every year if you sell me the information of your traders, if you sell me your orders, if you sell me every trade they execute. I want to see that information as fast as possible. You sell me that, I will pay you billions of dollars. And if they're willing to pay the brokers billions of dollars, imagine how much money they're making off of us every day on every trade, on every second, right? And because of that, brokers were like, wow, now my whole job is to get as many clients as possible, because the more order flow I sell to Wall Street, the more money I make. How do I make my business more attractive? Zero commissions. Zero commissions. Don't worry about it. We don't need commissions to stay in business. We have Wall Street paying us billions of dollars a year, right? Anyways, all that's to say, I still trade in a free commission broker. They most likely are making money off me. But still then, our hyper-scalping strategy is so robust that we can still make money even after those expenses. At the end of the day, you just learn to look at them as an expense, right? This is an expense that is kind of brutal, but it's a reality that if you want to partake in this game, those are the expenses you need to, you just need to pay for, right? Traders that look at the market as a hobby or a casino always lose. 90% of traders fail. 90% of traders lose money. Traders that just follow all others and aren't able to make their own decisions always lose. Trading has no help guides, nor does it have any rules to follow. God. Traders that think that they can get rich quick, they blow up instantly. Okay? This is a career. This will take months, if not years. Remember, at the end of the day, the trick is consistency, right? Trading is hard and it takes years to master. Some traders simply don't have the patience, the discipline, nor the aptitudes to become profitable, which is why we recommend for you to start in a simulator and figure out whether this is something you want to pursue or not. All right, and then a quick reminder of the trading learning curve. It took me 2.5 years of trying to become a profitable trader. And I'm not supposed to be here. I was simply meant to be another statistic, another trader that failed, another trader that made that bulk of 90% of traders failed, because I did fail for the first 2.5 years. And these were normal years. These were obsessive years. These were years in which I had no friends, I had no family, I had no nothing. It was just me, a dark room, 3 jobs to try to save for PDT, and learning how to damn trade, man. I learned so much crap out of the internet, from fake gurus, from fake indicators that don't work, from golden crosses, from trading alerts, you name it. I learned so much trash that I needed to unlearn in order to be profitable. That honestly, if I didn't have the determination I had, if I was quite literally willing, if I wasn't willing to die trying, I was willing to die trying. I was willing to trade for as long as it took, 10, 20 years. I was willing to trade until I was like 80 years old, because I had to see it through. Because if not, my other life option was to, I am from El Salvador. I'm from a third world country. The other option was to make $500 a month for the next 50 years of my life. So, necessity was driving me in a way most people wouldn't even ever fathom. Which is why when you are backed against the corner, that's what really makes somebody successful. Not to say that if you are in a well position, you couldn't be successful. Not at all. But what I'm saying is you will need a certain amount of drive within you, a certain amount of fire that only winners have, because the learning curve is going to be steep and it's going to take an awful lot of time, right? But if you're willing to put in the hard work, if you're willing to show up every day, if you're willing to aim up, as I said, I can't give you any guarantees that I will make you profitable, although I've done it already with a few of our students. Even though there's no guarantees, I at least can promise you that I'm going to show you everything I know. I'm going to show you everything I know, both scams in the markets, both patterns that do work, both indicators that don't work, that do work, trading techniques that do work, where to buy, where to sell. I'm going to live stream with you every day. You get to see every time I trade, every stock I trade, when to buy, where to sell. And even though I can't guarantee your success, what I can guarantee is a few things. One, that you will lose less if you trade this program, at the very least. And that might not sound as exciting as becoming a millionaire, but losing less is still not nothing. If you can lose less because I convince you to trade in a simulator, I convince you to follow my risk management strategies, or I convince you to dodge all these scams, that's already a success for me. Number two, what I do think can do for you is increasing the probabilities of you making it as a profitable trader. If the odds right now are 9 out of 10 people fail, I think people that follow our blueprint and follow our roadmap and don't skip steps, they trade correctly and they treat it as a career, I think your odds are way, way higher than that. Still no guarantees, but definitely way, way higher. And then finally, I don't know what's the other thing I was going to say. I'm just going to teach you everything and show you everything. All right. So I'm going to end it up here with this equity curve here, not equity curve, a learning curve on how trading will look like, right? As a beginner trader, most of you in this video, well, maybe not most of you, but anyways, as a beginner trader, the more you learn, the more you earn. The better you get at candlesticks, the more progress you see. The better you get at technical analysis, the more progress you see. It seems like, wow, I'm getting better so much faster. I'm losing less. I'm starting to make a little money. This is exciting. This is amazing. But in anything worth pursuing in life, you wouldn't encounter this dip. Why? Because it would be most likely an extremely hard career. You will encounter this dip. By the way, this is from a book called The Dip. You should read it. It teaches you when to give up and when not to give up something. And it teaches you that giving up is not a failure, right? You refocusing your energy can be as big as a success as becoming proficient at a business, at a sport, at trading, right? The Dip. It tells you that in anything worth pursuing that is hard, you will encounter a place in the learning curve in which the more you learn, the less results you're going to see. The more you practice, the less money you're going to make. The more you invest in education, the more you show up, the more you track your trades, the more you track your statistics, the less progress you'll see. It's a phenomenon that happens in anything that is worth pursuing that is hard. And this is kind of like that dip. It's like that stagnation point. All the beginner trader luck, all the beginner trader principles that you learned, kind of like those rookie gains, those came and went. Now you are hit with the part of the equity curve in which 90% of traders fail. In which the more effort you put in, the less results you see. I walked for 2.5 years through a tunnel in which I couldn't see the light at the end of it. Just walking, showing up every day, tracking my trades, recording my videos, reviewing the recordings of my setup, reviewing the executions I took, where I bought, where I sold, tracking my trading business. Every day, my life was slipping through my fingers. I had lost so many relationships, so many friends. I was away from my family. But I just kept walking. I just kept walking on this dark, cold tunnel without even seeing the light at the end of it. But I just knew that as long as I was getting a little less bad every day, multiply that by 10, 20 years, as long as my trajectory is upwards, I have to figure this trading thing out. And I did. I survived this dip. And what's crazy is I became profitable after deciding not to quit after my biggest rock bottom, which is why this learning curve is so accurate. It's like you're going to hit your worst rock bottoms. And the more rock bottoms you hit, in your mind, it's going to be like the closer you are to quitting. But for whatever magical reason, the
closer you are to quitting, also the closer you are to making it to the other side, assuming you are not insane. Which what does it mean? We reviewed the definition earlier. It means you are somebody that is insane is doing the exact same things every day. If you do the exact same things every day, you can go do it for 30 years and never become profitable. But as long as you are proactively becoming better, slightly better every day, and there's a slight slope to your learning curve, even if it takes X amount of years, you're eventually going to make it. And that was me. I wasn't one of the ones that got it in a few months, in a few days, in a few years. To me, it was almost 3 years of absolute obsession, which means that my progress and my slope, maybe it wasn't like that vertical, right? But at the very least, I wasn't going sideways. At the very least, I knew I was getting a little less bad. And with that in mind, I just went ahead, put in the work, navigated this dark, cold tunnel for 3 damn years. 3 years sounds like 2 words under the context of this masterclass. 3 years, right? 3 years is like, what? 3 years is nothing, it's the past. But 3 years while you are living them, 3 years is an entire life, right? And here at MMU, my goal is to shorten that learning curve for you. If it took 3 years for me, because I didn't have myself to learn from, you do have me to learn from. I hope that it takes 1 year for you, right? A year and a half for you, 6 months for you. There's some traders, especially the ones that are already kind of like break even, that join our community. They literally need an extra final push. They need an extra set of buying techniques, selling techniques, and they already turned profitable. There's a few of our members that became profitable after a few months. But the reality is that they didn't come as plain beginners. They already had been trading for a little bit and they just needed that extra push. But with that in mind, trading learning curve will be steep, will be tough. It most likely will be the hardest thing you ever do in your life. But hey, you know, you want to be good at something ever? This is what it takes. So there's that. And again, my hope is that you, by joining MMU, we can shorten this learning curve and increase the probabilities of you making it. Anyways, this is the rant. This is the masterclass. And before we end the video, we're going to quickly review one live trading archive. Or delete all the stuff. One live trading archive. Hopefully you guys have been enjoying this masterclass. It's been a long one, right? But hopefully you've earned some value out of this video. By the way, this live trading archive I'm about to show you, you also have access to the entire recording of it in the next class here underneath this one. By the way, this is obviously something MMU members have access to, not only this specific video, but also our full library, right? You get to see all my recordings, where I bought, where I sold, how many shares, all that stuff. How much money I made or lost, all that. And of course, every day, if you do join our main community, you'll be able to trade side by side with me. You're going to have my live stream on. I'm going to be on there giving you the best stocks that I'm looking at, giving you call-outs of the patterns that I'm recognizing, and you'll be able to see like my charts and all this stuff. But you also keep a recording of my trading sessions. So you can review them after, just like this one, you can review after. So the example I want to show you here is the first retracement, which is now we know as the pullback, right? The pull flag. So we find a stock, we did our due diligence, scanners, thousands of stocks, go down to 20, thanks to our scanners and our filters. Then we do technical fundamental analysis, we narrow it down to 1. PRFX is the one. Then from there, we do our technical analysis and mark levels of resistance and support. As you can see, there's a support level there of 8 that I marked out. And again, with the experience, you get better at marking these. And if you take our program, you'll get even better at it. But for now, if you at least are part of the community, you'll be able to see my screens. And in my screens, you can see which support levels and resistance levels I'm looking at. All right. So that is that. And now patience. I'm waiting for my pattern to form. I'm waiting for that MMU edge to show up. And once it's in front of me, I execute. I buy where I'm supposed to buy. I set my stop in place, and then I set my profit targets. By the way, I don't actually set real stop losses. It's more of a mental stop. So I know the price that I want to stop out at, but I don't put it out physically. I just know that if the stock drops 30 cents, I'm gonna stop out manually, right? All right, so look at what's happening now. The stock just went from lows of $4 all the way up to $10. And by the way, let me orient you here a little bit. So this is the name of the stock. This is the 1 minute chart. All of this should be making a little sense. Throughout this masterclass, we reviewed every single piece of the puzzle. Now you're seeing the puzzle all together as one whole operation. But this is stuff that you've seen already, at least surface level, right? So this is the stock I'm trading. This right here is the chart. This is the 1 minute chart. You can see 1 minute, right? This right here are the candlesticks. And these right here are the patterns. The patterns that I'm looking at real time. And these lines are my support and resistance levels that I've drawn, right? Down here, we have our level 2. This is kind of like our live quotes box, right? I'm both looking at the chart and at the level 2 at the same time, glancing back and forth between them when executing. And this right here is our order entry windows. How many shares do you want to buy? You want to buy, sell, so on and so forth. And right here is how much money I'm up on the day. And here is where it will populate the shares that I do buy here in a second. All right, so the strategy behind this is we did our due diligence. This is the stock we're trading, and I'm patiently waiting for the next setup, for the next MMU edge. We just rallied all the way up from 4 to 9, and I'm waiting for the first pullback, for the first big retracement. And as you can see, we are getting just that. We just dropped from 998 all the way down to 850. And look at this, I have 827 and 850, sorry, 827 and 8 as support levels. So what do I do the moment the stock drops? Well, I'm looking at the level 2. I'm seeing how the prices are behaving. I'm seeing how the candle is reacting to that level. As you can see, is dancing. And I go ahead and jump in 2,500 shares. So with the click of a button, with the click of a hotkey, I executed an order out in the open market and bought 2,500 shares at 8, right? Right there, right? And now what do I want to see? Oops. Hold on. Okay, what do I want to see? I'm still long, 2,500 shares. And what do I want to see? Well, I want this stock to give us resolution. Remember the targets. Targets can be high of day. Targets can be arbitrary of 50 cents, $1. What is my stop? Well, in this specific scenario, I was probably following a underneath support stop. Since we had this very strong support level of 8, probably I was going to give this stock wiggle room up until underneath 8. If we broke under 8, that's where I would have stopped, right? So let's say this is my risk, this little window right here. And then my profit target is something like this, double my risk, right? Right? So I'm risking from this for this stock to go from 880 all the way down to 8, right? And my profit target is for us to reach something like 12 or 11, right? That's my plan that I make on the spot and then I execute. Now I'm in the stock, right? I'm in at 880 and I'm looking at the level 2. The level 2 is showing us the prices. I'm also looking at how the candles are reacting. There's 848, right? 848. I'm already in the profit, $900. And what I'm looking for is that explosion. It's for my target to be hit. Can we see 10? There's 973. We're climbing up higher. 989 on the ask. We learn about ask and sizes and what all these names mean on our program. But for now, we're climbing up, right? It's 989, 1050, right? There's 1050. Then 1090 instantly, all the way up to 11, right? That right there for me is enough of a move to take profit off the table. So what do? With the click of a hotkey, I'm sending orders out in the open market to sell the entire position. Look at that. I am up $2,700, almost $3,000. Just like that, I book in the profit, and now I'm sitting up $7,900 on the day, right? How long did that take? 30 seconds? 40 seconds? That right here is what we say is a hyper-scalp. Extremely fast. I make, a lot of money. $7,000 is a lot of money off of micro movements. Again, something that before traders wouldn't think you can make money out of. You need to buy the stock at 8 and sell it at 900, right? Buy it at 8 and sell it at 50. But I am buying it at 8 and only selling it a few cents higher, 80 cents more, right? 100 cents more, $1 more. Still relatively micro movements, right? And this honestly is one of our larger winners. I can still make money with only 10 cents. If this would have dipped and bounced 10 cents, I was already in profit, right? All right, but feel free to check out this entire recording. Is down below in the curriculum. And I think that's going to do it for the masterclass. Thank you for joining me. It's been awesome hanging out with you for these 2 hours. Hopefully you earned a lot of value from this video. Hopefully I can see you on the other side of the community. Hopefully you take the leap of faith. You believe in the strategy. You want to learn more about the hyper-scalping strategy. You like the way we teach. You like our transparency. And you give the strategy a shot. I'm going to see you on the other side with our full courses, with our live mentor sessions, our coaching calls. And then, of course, I'm going to see you in the chat room. We're going to trade every day. You're going to see my live trading every day. You're going to see the stocks that I'm trading, where I'm buying, how much money I'm up or down, all that good stuff. And hopefully you can make also some friends here in the community. We are smaller than most communities, but we have a lot of awesome people in our community, and I'm sure you can make some good friends out of MMU community. So it's been Marcelo. Thanks for tuning in. This is the masterclass, and I'll catch you guys soon. All right, take care.